So the trading method that I'm going to explain in this video was originally developed by Mark Minervini in his book How to Trade Like a Stock Market Wizard. That book focused on a trading method known as the Volatility Contraction Pattern, or VCP for short, which essentially helped Minervini make a 33,000% return over 5 years. The method is basically based around allowing small retail traders like ourselves take advantage of big moves created by institutional investors, JP Morgan, big banks, that sort of thing. So essentially what we're trying to do is find stocks in large uptrends, which are usually caused by large institutional buying, and we're basically waiting for a dip and the formation of a base. At the end of that base, there should be a moment where the stock's volatility totally drops, and this is the point right before the big move continues, and that's what we want to take advantage of. So just before we get into actual stock analysis, I want to show you this graph where we have the 4 different phases of a stock's cycle. So there's phase 1, 2, 3, and 4. We can also call them stages. And then we also have the 30-week moving average. So basically we're looking for stocks in a phase 2, this uptrend right here, because we don't want to be buying stocks that are going sideways here in phase 1 or phase 3, and we don't want to be buying stocks that are losing money either. So of course we're going to go for phase 2, and we're going to want to try get in as early as possible on phase 2 without kind of still entering in phase 1, because that's all wasted time that we could have been in a different stock. So basically, if you can see the pointer here, we're trying to enter about here, which is when we can see it's going from phase 1 to phase 2 is starting, and we can ride most of this. You're not going to get it perfect, you're not going to get the top, you're not going to get the bottom, so you're trying to get the biggest chunk of this here. And what we're actually looking for when I say base, you're looking for this sort of, we see the moving average moving up in an upward direction, the stock price is above the moving average, and we're looking for a base, like a kind of halt in the stock's price. It's going up and then it kind of slows down for, it might be a week or two, and it kind of builds a little base here, and then once the base is finished, there should be very little volatility within the stock's price for a couple of days, maybe a week. That's exactly when we want to buy, and then that's when you'll see the volatility and the volume on the stock shoot up again, the price goes back up, and then we're away again. So I'm going to be using TradingView to view stocks and kind of screen for stocks as well. Feel free to use whatever screening platform you like. I just like TradingView because that's what I do my analysis on as well. So if you're going to copy me, you're going to go with TradingView, you're going to go to products, screeners, up to stock here, and the screener is very simple because you don't really want to exclude any stocks that may potentially be winners for you. So this is what I like to do. I have 4 filters. The exchange, obviously we're going to go for the US exchanges. Market cap, I like to go for between 300 million market cap and 5 billion. I just think that that's a lot of the stocks in these kind of market caps. You see a lot more stage 2s in these compared to in the hundreds of billions. And as well, once you go below 300 million, there's kind of no institutional activity, and again we're looking for that institutional activity. And we're going to go for simple moving average is above the 200 moving average, and then the 200 moving average is below price. So that's pretty much, those are all the screeners I have for now, and it brings up 1,226 matches. Okay, so basically what you're going to want to do is just go through all of these, or maybe not all these, there's 1,000, but as many as you can or as many as you want, until you find good stocks that have bases that are in stage 2s, and basically so I'll go here. I'll pick the first one, MLI. Okay, so we're looking at the daily candlesticks, and usually I go for about a 1 year period, maybe a small bit less, maybe like 1.5 years, 2 years, just to get a good sense of the direction of the stock. So here we have the purple is the 200-day moving average. That's in an uptrend, tick. We have the 150 in an uptrend, and it's also above the 200. And then we have the 50 in yellow. That's also above the two of them. It's also in an uptrend. And then we have the stock is above all three moving averages. So this is a stage 2 stock. This is good. It's exactly what we're looking for. If I was kind of trying to find stocks right now, I would see this stock, I would put it in my watch list. It doesn't have a VCP setup right now, but that doesn't mean it won't in the future. Maybe if I keep this on my watch list for 2, 3, 4 weeks, come back to it, there may be a VCP pattern that's set up, and we can go ahead and enter that stock. So I'll go through a couple others here. KRG, let's have a look at this one. Okay, so this one would not be classed as stage 2 because, I guess we do see the 200 is slightly in an uptrend, but then we see the 50 isn't above the 150, and that's a bad sign. We don't want to see that. And even if you just zoom out like this, it's a big kind of zigzag. It's going sideways. You know what I mean? So that would be classed as a stage 3 stock right here. So there's a big fall down here during COVID. That would be stage 4. And we have the base building here. That would be stage 1. Then boom, up here, up until around June 2021, that is a stage 2. And then since then, we've had a stage 3 kind of halt. So I would stay away from this stock. So here's an example of a stock that's in a stage 2 uptrend and also has a volatility contraction pattern. So we have PSN here, Parsons Corporation. If we zoom out a bit, we're still on the one day candles. We can see it's been in a stage 2 uptrend since about, May 2022. And then we have the stage 2, we have the 200 in an uptrend, the 150 above that in an uptrend, the 50 in above that in an uptrend, and then price above that too. It's been building quite a large base actually since about November, December. So that's about a 6-month base. Bases usually will be about 2, 3, 4 months. But if they are bigger, it means there's a lot of supply that is being kind of taken off the table, which is absolutely perfect for us. So it really means that there could be a bigger move than usual with this stock. So what we're looking for a VCP is, so once we understand that it's a stage 2, we're looking for a big move up here, and then price kind of falling down, and then we're going to see waves here, so down, up, down, up, down, up, and then the very end of the base here, we can see there's very little movement in the last maybe 2 to 3 weeks between the price. Like here we have large swings. If I can bring up this tool, let me see if I can get this up. Yeah, so like here we have down, it goes 16%, and then we have up 16, down 16, up 14, and then if we look at recent movements, if we look at recent movements, it's been maybe like 1.5, maybe 2% movements each day. So basically we're seeing a cup and handle play out here. Here's the one end, here's the cup, and then this is the handle in a tiny little volatility contraction pattern. So basically what I would do here is I would zoom into this part. I would go up and get my trend line tool. I'll kind of draw a line where there seems to be a bit of rejection of the price. Draw it along here, and then once the stock breaks above this line, that's when I'm buying. What I would do as well is, if I can get up my tool for the long position, I would enter, let's say tomorrow it breaks above about here, okay? Now, another thing is you're going to want to be very careful about the risk you take on. You don't want too much risk. Usually I'll go for, depending on the stock, I'll go for maybe 2-3% risk maximum, and that's a hard stop loss. I'm selling as soon as that happens, no matter what. If it takes 30 minutes to hit that stop, I'm out. If it takes 5 days, I'm out. So for example, for this stock, I would look, if it breaks above this kind of pattern, I'm looking at a stop loss of maybe 2.5%, about here, 2.3%. And then if we zoom out, there's not a whole lot of overhead supply besides this sort of area. So I'm looking at maybe 10% profit here. So if you enter this, you're looking at, that's about 4.5 risk to reward. So yeah, if it plays out, you're 10% in the green. If it doesn't, which not every position is going to play out, you're looking at a maybe 2 to 2.5% loss. The thing with these VCP patterns is that they are very reliable. Of course, they're not going to work every time, because that would be a cheat code. So they're not going to work every time. You're going to take losses, but it's about making more than you lose, right? And this is why we have a big risk to reward ratio here. So 4.5. If I can, if I take 3 trades here, if I take 2 trades and only one of them works out, I'm still in the green. If I make 2 losses of 2% and make 1 gain of 10%, I'm still making money out of those 3 trades. And then if you take that over a long enough period, take into account the compound interest, and you're making a lot of money.